Hey, Dustin Tibbits here, financial advisor with Jazz Wealth Managers. Says so right on the shirt. Today, we're going to talk about the number one mistake that I see, and we all know, in your Roth IRA. We're going to make it really simple, really quick, but I'm going to expand on it and give you some more detail that maybe you've never seen before. So let's take a look. Being too conservative with your investments. The 2025 contribution limit is $7,000. IRA contributions to Roth accounts currently make up 66% of all accounts. Basically, the big brokerage firms got together and said, what's your percentage? What's your percentage? Let's figure out what it is together. So that's where we stand. Now, the Roth IRA is tax-free, so we don't need to be conservative. We shouldn't be conservative. We can occasionally have a little cash, right? And just like be waiting for a little bit of a downturn, not much and not for long. Also, most people will take their IRA, their 401k, Roth IRA, and any other accounts you have, and they'll just invest them the same way. Makes it easy. I give you that. It makes it easy. But your Roth IRA should be more aggressive. It's often the smaller account to get started versus your 401k. And maybe we play that a little bit differently there. And the other part is there's a sliding scale here, right? If you have too conservative of investments in a Roth IRA, you would take the same investments, put them in an IRA, you almost would have been better off tax-wise if we take it out a long enough period of time. It's really interesting to see there that you would have just been better off putting those investments elsewhere instead of the Roth IRA. Now, performance-wise, if we look back through the lifespan of the S&P 500, a conservative portfolio as defined by the percentage of stocks to bonds, right, averaged a 5.78% return. A balanced portfolio, we're going to go over this in a second, averages 8.3%. An aggressive portfolio, which just means basically directly in the S&P minus a tiny bit, 10%. For bonds, ends up with a 9.62%. It's not much better if you were all in on the S&P. It's like 9.91 to be exact, or very close to exact there. So there's a 66% difference between the two. And again, right, we want to have the most tax-free growth that we can get. If we just kind of plot that out in a really, really simple way here, and we say that you started with $7,000 and you worked your way, and you didn't put any more money in, you worked your way through. The difference between a conservative portfolio down here at the bottom with a 5% return and a 7% return, almost double, right? So we don't want to be too conservative in the Roth IRA. If you're thinking about some different things that most people won't take a moment to talk about, if we talk about having your initial contributions in cash. Now think about this. This happens because the best time to contribute fully to your IRA, in this case, the Roth IRA, is the first available trading day of the year. That's it. There's been studies on this. Like if you want to use history as an example, that's it, right? So the trouble is most people go, well, yeah, the market is at highs. I will put the money in, but I'm not going to invest it. No, that's not what the studies show. It says to invest it at the beginning of the year. Well, a lot of people won't do that because they're like, the markets are at highs. I'm not going to do it. It's, I would argue, fine for a small window of time. You can't have cash in a Roth IRA for a very long time. Treating all your accounts the same. It's a very normal, kind of a lazy way to do this, but we sometimes fall into that trap of just investing everything the same way and saying, well, I want the same growth no matter what. Ignoring Roth conversions. It's a side mistake that I wasn't going to touch on, but hey, we're here. So when your income changes, usually to the downside, we'll consider a Roth conversion from that IRA to the Roth, because that IRA should maybe not be invested as aggressively, depending on your age. And then you end up moving it to the Roth and it starts moving up a little bit faster, that after-tax aggressive growth. On the flip side, I debated putting this here because it's like, overdoing conversions. Well, it depends on your age and it depends on what you're trying to do with the money. I have numerous conversations with clients every day that we go, well, if you convert, you actually will die before you could have spent the money that you're going to get off of that conversion. So it's a tough conversation, but it's fine. Last mistake here is a big one, taking distributions before the age of 59 and a half. Now, you are allowed to, in your Roth IRA, take the contributions that you put in, you could take them out at any time. There's no 5-year rule. Everybody, I've seen the videos. These, unfortunately, they don't know what they're talking about. You can go on the IRS's website. You can look in the tax code. If you put in $1 today in a Roth IRA, you could take it out tomorrow. No penalty, no tax. If the dollar happened to earn some money, that's the tax. You put in $1, a week goes by, the market shoots up, and now all of a sudden you made $2. You could take that $1 out, no problem. But if you take out that other dollar, that's where the penalty and taxes come into play. So anyways, just mean to get off topic there. So traditional logic and the way the industry presents it is, hey, if you're age 20 to 30, we're going to be 90% stocks, 10% bonds. You can see how this changes. We're going to be 80% stocks, 20% bonds in your 30s and 40s. I would have a little bit of an argument in here based on who you are. That doesn't fit everybody. I think it's an individual thing, but generally speaking, that's what they say. Then when you get in your 40s to 50, 70 and 30, then 60, then 40, then 50, then 50 as you get into your retirement there. Come on, that's such a general thing. So a little bit tricky there. Now, just remember as you go here, we want growth in all ways in the Roth IRA. We want to make sure that they call it asset location. We want to make sure that we don't have junk or really steady dividend stocks in your Roth IRA. It doesn't make sense to have that there. We also want to invest that cash immediately as you do it. I would argue most of our clients, because we focus on the pre-net worth client instead of the high net worth client, but we look at them and go, you probably can't throw in a big chunk of money at the beginning of the year. What's the next best option? So we went through the entire market and studied the whole thing just to figure it out. All right, do what you can there, but don't be leaving your money in cash. Roth conversions, remember, that's something you should consider. If your income changes, I tell my clients, if your income changes, I want to know, right? Because if it goes up too much, you may not be eligible for a Roth. If it goes down a little bit, we might be able to do a Roth conversion. I want to know if it changes. And then plan for the long term, right? Most people that are using Roth IRAs, it's not the first account that you're going to take out in retirement. Right? You're going to draw from your IRA probably initially, maybe your 401k, your SEP IRA, whatever. The Roth IRA, from a withdrawal strategy perspective, tends to be the last one. So the Roth IRA is not growing until retirement. It's growing until later in retirement and therefore can stay aggressive longer. Really break this stuff down. It's how people end up with more money than you would have had. And if you don't know how to do it or don't want to do it, well, I sure hope you'll check us out at jazzwealth.com because we love doing it. We are the 36th best advisor in the United States, ranked by USA Today, which, there's like tens of thousands of advisors. So pretty cool. Love to hear that. Otherwise, throw me a like and subscribe if you learned something or got motivated to do something with your dough. We want to help you keep your dough straight. All right, that's all I got. See ya.